JP Morgan's head of global strategy, Marko Kolanovic, expects the stock market to rally 7% in this upcoming week. So apparently, the stock market is about to go crazy. Let's take a look at the good and the bad here in this video. And for good measure, I hope you guys enjoyed your weekend. I got myself a little cowboy hat, which I think is probably the coolest cowboy hat that has ever been known to mankind. So without any further ado, hit the like button, subscribe to the channel if you guys find value out of the video. Thank you for watching, and let's get to it. First things first, JP Morgan sees portfolio rebalancing lifting US stocks 7% in this upcoming week. And it goes on to say, U.S. equities could see a 7% move up next week as investors rebalance their portfolios after a brutal first half of the year, JP Morgan's chief global market strategist Marko Kolanovic said on Friday. Next week marks the end of the month, second quarter, and first half of the year, making for a busy time for investors with fixed weight portfolios who must rebalance their asset exposure to account for past market moves. While these rebalances typically do not tend to become main market drivers for markets, they can assume a more important role when markets move over rebalancing windows where large and in the same direction, as is the case now, JP Morgan strategist led by Kolanovic said in a note on Friday. The S&P 500 is down about 14% for the quarter to date period and down 18% for the year. So a lot of the pain so far in 2022 has been felt in the second quarter. So you are not the only one. A lot of hedge funds are feeling a lot of pain as well. And a lot of hedge funds have a lot of short positions. So essentially in English, what Marko Kolanovic is saying is he is saying that a lot of stocks have been sold off too aggressively, and potentially some of your safety stocks have been bid up too much. So hedge funds that like to keep their risk exposure in line might want to buy up some of those stocks that they have previously sold short, like a Square at $70, right? This stock hit under 60. I was buying that thing super heavy. SoFi, another one, going from $24, $25 at the peak down to $5. I think it's clear that you've squeezed out all of the money that you're potentially going to make if you short that stock, and it makes a lot more sense to go long on that stock. Same thing with DraftKings, Affirm, PayPal. So many other stocks are beaten down to levels that they should not be at, and when you take a fresh look at the portfolio, he's essentially saying it makes a lot of sense to go long on a lot of these stocks instead of continue to short a lot of these stocks. Now, forget what Marko Kolanovic says. If we get data that comes out that is bad, the markets are not going to rally 7%. Because that is a very, very bullish expectation, essentially saying the stock market is going to go crazy in this next upcoming week. Now, let's take a look at what we have as far as data that is coming out. Some of this is right here in the tradingeconomics.com calendar, which I do highly advise you guys use this for yourself, because it will give you guys the most important events that you will need to know about that will move the markets. Now, what we have as far as data is nothing too crazy for Monday, Tuesday, and Wednesday, but what we do have on Monday is going to be Nike earnings and durable goods orders month over month. Nike earnings will actually be very important for the markets because it will show a lot of insight into that producer inflation potentially if costs are starting to come down or if they are continuing to remain very high. It will also give us a little bit of a glimpse into the consumer. If Nike reports really good earnings, I think it's going to be hard to be bearish on a lot of consumer stocks, a lot of, more goods type of stocks, right? A lot of people are expecting good demand to go down in a big way, and a lot of services to do very well, like cruise lines, airlines, so on and so forth, right? So there is that. That is what we have in store for Monday. On Tuesday, you actually do have Fed Jerome Powell that speaks again, and that could be important. Maybe he, slept on something over the weekend, gives us new information. I don't necessarily expect that, but if that happens, that will be something that can move the markets in a big way. You do have the Case-Shiller Home Price Index year over year, which does come out 8 o'clock in the morning on Tuesday. Wholesale inventories, month over month, retail inventories, excluding autos. That data comes out around 7:30 in the morning on Tuesday, but I'm not expecting it to move the markets in a huge way. It is possible, but I just don't expect that. Now, you do have PCE price index that does come out on Wednesday. GDP sales Q1, the final numbers, retail consumer spending, some important data points, but it's not like CPI. It's not too crazy, right? I think the markets will be able to shrug off potentially a good deal of negativity unless we get something that is substantial. So that's what we have for Wednesday. I think really overall Monday, Tuesday, Wednesday could be pretty chill, depending if the Fed says something we like or don't like. That's going to probably move the markets the most for the first 3 days of this upcoming week. Now, on Thursday, that's where things get a little bit more dicey. Let's just call it that. Personal income month over month does come out at 7:30 in the morning on Thursday, 7:30 in the morning as well. Personal spending month over month, and then you get the PCE price index month over month and year over year, as well as initial jobless claims. So I think Thursday is really the first day where you could get some fear, and also fear heading into the weekend. Typically on a Thursday or Friday is when you start to get more fear, and when you start to see people that just overall don't want to hold over a weekend. So we'll see if that happens. Obviously on Friday we rallied into the close, which is a good thing, and we will talk about that here in a second. And then on Friday you do have the ISM manufacturing PMI, and that's probably going to be the most important catalyst for this upcoming week. But that is on Friday, so I do expect at the very least you could have a bullish Monday, Tuesday, and Wednesday. Thursday and Friday could be ultra bullish as well if we get good data. Now, this is only short term. Keep this in mind. This is not to say the bull market is here. If you are buying stocks right now, you should expect them to go lower. Obviously, it's a good time to be buying stocks. This is a buying opportunity that you do not get all too often, and might be one of the last great buying opportunities that we are going to see for 5 or 10 years. That's very possible, and that's what I projected here in these videos on this channel. But you got to be prepared for the stock market to go lower and hit lower lows, because it is going to happen. Specifically, in my personal opinion, take it with a big grain of salt. Take it for what it is. I'm not a fortune teller, but you do have the Fed that is raising rates again July 27th, 2022, with about an 81.4% probability of a 0.5% rate hike. We know if the expectations go up, if we start to expect a 75 basis point rate hike, that's what we're going to get. Even if the markets go super crazy and they start to expect a 1% rate hike, we know that is what the Fed is going to give us. So you want to watch this Fed rate monitor tool very, very closely. You could just Google search that, investing.com Fed rate monitor tool. It'll bring up all of this information that you guys need to know. But on top of that, you do have advanced estimates for Q2 GDP, which comes out July 28th. And if we go into a technical recession the day after the Fed just raise rates, I think it's very possible that we get this dynamic shift in investors' minds that says, hey, that finally realize the situation. To be overly dramatic here, that inflation is over 8%. The Fed is raising rates as we are in a recession. At the same time, only the second time in history we have had Q2. So all of these, QT, all of these things have not happened at the same time before. And even to go back to when the Fed was raising rates as we were actively in a recession, you have to go back a very, very long time. You have to go back to the 1980s, the early 1980s, and that was obviously not a good time for markets. So that is basically that. The short interest on the S&P is still over 18%, but that is what we have looking ahead for this week and for the next couple of weeks. That is really it. If we do get more downside, you want to watch this FINRA margin debt, because the margin debt has only went down about 15%, and the NASDAQ was down over 30% at its peak. That is really compressing a lot of hedge funds, and I want to see this margin debt come down after this portfolio rebalancing. If not, we're going to be in for a pretty big downside reaction once we do go into that recession, probably July 28th. There's a lot of people that know nothing about finance that are talking about a recession. I think that's a pretty good sign in and of itself that we are probably in a recession. So thank you guys for watching. Looks like the stock market's going to go crazy. You guys enjoy the rest of your day, and I will see you in the next one.